Hello and welcome. You're watching NDTV Profit and I'm Pallavi Nahata. I'm in conversation with Amit Pandey, Vice President of Financial Institutions at Moody's Ratings, and we're also joined by Karthik Srinivasan, Senior Vice President and Group Head for Financial Sector Ratings at ICRA. Thank you so very much to both of you for taking time out for us. So Amit, we'll start with you. Tell me something, given that you said that you look at the financial space from a global perspective, how do Indian financial institutions currently stack up? And would it be correct to assess that Indian financial institutions, banks as well as non-banks, appear well placed at this juncture?
Yeah, so first of all, thank you for inviting us. Yeah, it is true that if you look at the global backdrop, Indian financial systems seems to be very well placed. So we have some negative outlook on US banking system. We have negative outlook on some of the economies in Europe, including Germany, France and UK. And we have a negative outlook on banking system of China as well. And there are various reasons for it. So the first one is that if you look at the European economies, the interest rates have been increased in last 12 to 18 months, and the economic growth is quite low over there, which is having challenges for the banks in terms of its asset quality. In case of USA, they are facing challenges related to their commercial real estate exposure, especially some smaller regional banks. And in case of China, we understand that the economy is going through a deleveraging cycle, the population is aging, and they are having challenges related to their property sector debt and local government financing vehicle. Now, if you contrast all of this to what is happening in India, the economic growth is quite strong, the loan growth is also there, the banking system is sitting on the record profitability, and their capitalization has also improved. So, on a relative basis, Indian banking system truly stands out in global context.
Right, and talking about the outlook, like the expectations going forward, that's expected to remain fairly strong as well in case of India, right? We're expecting to see growth coming off a little bit, but credit growth is expected to stay broadly resilient, and whatever you've spoken about in terms of financial institutions and their asset quality and the outlook going forward, that remains strong.
Yeah, that is true. In fact, what I would say is that if you look at the last year, the nominal GDP growth in India was close to 10%, while credit growth, excluding the HDFC merger, was about 16%. So there is a gap between the nominal GDP growth and credit growth. Now, whenever that happens, we have to be a little cautious that whether the credit is running ahead of the cash flows in the system. So thankfully, I think RBI has taken some steps, which means that the loan growth next year would still be strong, but would moderate a little bit. Our expectation is more to the tune of 12 to 14%. So from a macro stability perspective, it's a good thing that would happen. And obviously the other thing is that the deposit rate, the deposit growth rate in the system is running close to 12-13%. So it's also good for the funding of the banks because they won't stretch their balance sheet too further away from the deposit growth rate. Apart from that, I think profitability should still be healthy with little minor downtick, and capitalization. Indian equity markets are quite buoyant, and that gives them enough opportunity to raise capital if they need be.
Sure, okay. Coming to you, Karthik, so we have seen a rise in domestic funding costs as well in recent quarters. Going forward, what is the outlook in terms of funding costs, and also juxtaposed with fairly strong credit growth? What is the outlook looking like for banks as well as non-banks?
We currently have a stable outlook on both banks as well as non-banks. So we expect the growth momentum to continue into FY25. Yes, the growth rate would not be as high as what we saw in the last fiscal. It will definitely come down, but it will still be fairly attractive, early teens, maybe 12-13% for banks, and possibly higher teens for NBFCs, which will still be lower than what they have done in the past. But in terms of interest rates, it'll probably take some time before RBI starts cutting rate, and to that extent, the impact to get translated onto the financial sector. From that point of view, there would continue to remain an upward bias in terms of cost. Even over the last couple of days, we've seen large public as well as private sector bank raised their deposit rates across various tenors. So interest rates are not really going to come down very fast. But having said that, we do believe that banks and NBFCs would be by and large be able to protect their margins, though slightly with a downward bias, but it should not be something which would completely derail their P&L. They should be easily be able to manage a small drop in the interest margin consequent to a continuation of steady rise in the deposit cost.
Okay, so you've touched upon the recent hike we've seen in deposit costs. In terms of numbers, any estimates you can give on the expected impact for banks?
No, as I said, banks and NBFCs are institutions who borrow from one and lend to the other. So by nature, they would be in a position to manage on the interest cost. Yes, there would be a gap of a couple of quarters here or there, depending on how the assets and the liabilities are structured specifically for each one of them. But by and large, it should be manageable. If you were to specifically ask of interest margins, we believe that there could be a downward bias about 10 to 20 basis points on the NIMs across entities. But at the same time, it would not completely follow on to the P&L because banks and NBFCs both would possibly benefit from economies of scale. Their OPEX would be under control. Plus, the asset quality or the credit environment is still benign. Now, there could be some uptick, but by and large, the credit costs are still expected to remain lower or at similar levels that we've seen in the past. So net, when you come down to return on assets, the impact may not be material as such.
Tell us a little bit about asset quality. At this point, especially for banks, there are no asset quality concerns per se. For non-banks, while in case of the smaller non-banks, we do remain slightly cautious. What is the outlook going forward? How are you viewing it?
When you talk of asset quality, a big picture kind of a comment for both banks and NBFCs, we expect continuation on the improvement in asset quality, means NPA numbers to continue its downward trend. Having said that, certain segments like unsecured lending, where the RBI has also been cautious and asking banks and non-banks to slow down, and the very fact that we have already witnessing some slowdown in credit to those segments. So that's a segment where we see some rise in delinquency and consequently NPA numbers. But at a broader level, that should still be capped within about 15-20 basis points, not really more than that. Secured asset classes, home loans, HFCs, there we expect the asset quality trend to continue its downward path. It's only be certain segments of NBFCs, unsecured lending, wherein we may see some uptick in terms of delinquencies. But at a broader sectoral level, numbers should still be somewhere at the similar March 24 levels itself as we head into March 25.
Okay, and you've spoken about how we could see even going forward some cautiousness in pockets given the recent RBI measures, as well as the fact that we've already seen a little bit of easing in credit growth. What is the outlook there in terms of profitability as well as growth?
As I said, growth numbers would definitely come down for NBFCs. If you were to talk, our estimate for March 24, year ended March 24, was NBFCs possibly grew at slightly above 20%. That number we expect to come down to about 17-18% kind of a levels for FY25. Housing finance companies have been growing in that ballpark 12 to 14% kind of levels. They should be in a position to maintain those. Wholesale lenders, infrastructure finance companies, though they would again continue in that 10-11% kind of a levels. But within the NBFC, certain segments like unsecured lending, which have been growing well in excess of 30-35% over the last couple of years, we would see a marked slowdown on those segments to possibly into mid-20s or something like that. So that will basically pull down the overall NBFC growth numbers. In terms of profitability, while I articulated that there could be about 10-15 basis points compression in margins, but an improvement on the OPEX and the fact that credit cost may still continue to remain low would ensure that the overall ROA numbers don't fall more than 10-15 basis points So from that point of view, ROA will be marginally down from FY24 numbers, but still be fairly high if you were to look at the last 5 to 10 years kind of profitability numbers that the sector has shown. Similarly, on the bank front as well, FY24 was possibly a last decadal high in terms of a sectoral ROAs of 1.2, 1.3%. Possibly that number could come down closer towards 1%, but still 1% for a banking sector, given their scale and size, I think it's a fairly good numbers to have. More so, it looks all the more attractive when you look at these numbers, with reference to a global perspective and the opportunities that's there in the Indian markets.
As an institution, what are you expecting in terms of the Fed rate cut trajectory going forward, and what are the global implications?
So I think it's across the board the similar nature. So all the central bankers have increased the rates to tame down the inflation. Now, if you look at inflation globally and including India, it has reduced. It just so happens that it has not reduced to the level that the central bankers globally would like to see. At the same time, the economy was still growing very fast. I think we are now getting closer and closer to that stage where the inflation dynamics along with growth are getting ripe for some rate cuts to happen. So we would expect some kind of a rate cutting cycle to start soon. For globally and for emerging markets, I think the emerging market cycles do tend to follow Fed to a certain extent. Now in India, if you really think about the asset quality, so one of the risks while we are talking about some of the micro markets like unsecured lending and so on and so forth, but another reason for getting little cautious about the asset quality in India is that within India, the rates have been increased by almost 250 basis points. At a policy level, the bank and bond market rates have gone up by 180 to 200 basis point level. And as the loans also season at a higher interest rate, you do tend to see some delinquency inching up. So to that extent, some of the rate cycle turns globally and domestically, it would help the asset quality at the margin.
Okay, all right. And Karthik, one last question to you as well. So in terms of sectoral deployment, especially from banks, do you think that we're now seeing more broad-based sectoral deployment of credit? For instance, where I'm coming from is that in terms of the capex cycle that we've been talking about, for quite some time we've seen credit growth being, it wasn't as broad-based as one would have wanted, and some sectors have been outperforming the others, but do you think that's increasingly more broad-based, or is it still restricted to specific sectors driving credit growth in manufacturing?
No, if you're talking in terms of a broader sectoral allocation, the pendulum has moved from corporate lending to retail over the last couple of years. So it's completely moved from one end to the other. Within the manufacturing, again, last couple of years, we've not really seen much of corporate loan or credit activity as such. So to that extent, one can say it's a bit broad-based. But again, that's really a segment which has not really grown. So I'm not sure if it's right to give credit that the banking sector has broad-based its corporate exposure. I mean, the opportunities are limited. We are still hearing of corporate capex, but it's yet to come. So what I feel is, at a broader level, the pendulum has swung from the wholesale credit to retail. Possibly it will continue at least into this financial year. Once the capex cycle starts, one shouldn't be surprised if the banks again move back towards wholesale and infrastructure kind of a lending. So that becomes an important point from a socio-economic and also from an asset quality point of view. Last 2 to 3 years, we've seen significant growth on lending to SME and the retail segment. The moment the funding slows down sharply, then they could throw up some asset quality challenges. So it's better that banks as well as NBFCs start becoming a bit more cautious on their retail lending from the current juncture itself, so that tomorrow, once the corporate credit picks up, you're still able to manage the asset quality not only on the corporate side but also on the retail side.
Okay, thank you so much to both of you for taking time out to speak to us today. It was a pleasure.